in the mid-1760s, the British Empire, propelled by the British East India Company, had accumulated enormous amount of wealth through colonization. An aura of over-optimism was created, and a period of rapid credit expansion by many British banks ensued. This, however, came to an abrupt end on June 8, 1772, when Alexander Fordyce, one of the partners of the British banking house Neil James Fordyce and Down, fled to France to escape debt repayments, eventually triggering a banking panic in England. Welcome to the Why in History. I am Ajay Kaul, and today we are talking about economic crises in the modern world, their origin, and how they ultimately were overcome. So this credit crisis of 1772 was the first known economic crisis to hit the globe in modern times. And of course, the fuel for the crisis was the expansion in trade propelled by British colonialism. During the decade prior to 1772, Britain had made most of the expansion in colonial lands, and that required significant capital investment across the East and West Indies and North America. Now, capital was scarce in American colonies, and the colonial planters were eager to borrow cheap capital from British creditors. But because the planters maintained open lines of credit through multiple trade channels, the creditors had no way of knowing a particular planter's indebtedness. So a planter could have 5 lines of credit open across 5 creditors, and none of them would know that this client of theirs was already in debt across all the available sources of credit. So when the London bank Neil James Fordyce and Down triggered the banking panic in England, creditors began to form long lines in front of British banks to demand instant cash withdrawals. And this crisis rapidly spread to Scotland, the Netherlands, other parts of Europe, and the British American colonies. Some historians have claimed that the economic repercussions of this crisis was one of the major contributing factors to the Boston Tea Party and the American Revolution. But towards the end of 1773, almost within a year, the crisis seemed to be over and the financial markets were on a recovery path. The Bank of England had a significant role to play in expediting the financial recovery. It intervened in the bills of exchange market and extended short-term loans to the cash-strapped banks. The next big global economic crisis to hit was the mother of them all, the Great Depression of 1929 through 39. Yes, 10 whole years of depression in the early 20th century. The trigger point of the Great Depression was the stock market crash of October 1929, which sent Wall Street into a panic and wiped out millions of investors. Post that, there was an unfortunate chain of events, which included consumer spending and investments dropping, steep declines in industrial output and employment, and companies laying off workers. By 1933, the Great Depression reached the lowest point, with some 15 million Americans unemployed and nearly half the country's banks having failed. So what led to the stock market crash in the first place? Well, you could draw a parallel with the 1772 economic crisis. The 1920s, also known as the Roaring Twenties, was a period of rapid economic growth in the US economy. And one place where you saw returns of this growth was the US stock exchange on Wall Street. By the 1929s, almost everybody was pouring their savings into stocks. From millionaires to cooks to janitors, everybody wanted to get the returns that the stock market was providing to the average investor. But the greed multiplied and people started borrowing to invest in stock, which meant if the price of the stock came down, there was no way they could pay back the lender. And as soon as the economy started showing signs of slowing down, panic ensued and nervous investors started selling overpriced shares. Not in ones and twos, but en masse. On October 24, 1929, 12.9 million shares were traded, and that day came to be known as the Black Thursday. So the immediate impact was that the consumer lost their buying power because of the loss in value of the stocks. And that led to industrial production reducing, and that led finally to industrial workers losing their jobs. So how did this crisis spread globally? Well, the globe adhered to the gold standard, which joined countries around the world in fixed currency exchange. And as the economic woes increased in the US, that had a ripple effect across the globe because of the standard gold exchange. While a lot of economic effects continued to happen, but by the fall of 1930, the first of the four waves of banking panics began as large number of investors who had lost confidence in their banks demanded the deposits in cash. That meant banks had to liquidate loans in order to supplement their insufficient cash reserves. Yeah, the cash reserves were insufficient, so the banks were not able to meet the demand. And by early 1933, thousands of banks had closed their doors. Now, President Herbert Hoover, who was a Republican, believed that government should not directly intervene in the economy and that it did not have the responsibility to create jobs or provide economic relief to its citizens. Net result, the bank runs continued. And then, in November of 1932, the country elected a new president, Democrat Franklin D. Roosevelt. And soon after his inauguration day of March 4, 1933, Roosevelt took immediate action to address the core economic woes. He first announced a 4-day bank holiday, during which all banks would close so that Congress could pass reform legislation and reopen only those banks which were determined to be sound. And on the psychological front, he also began addressing the public directly over the radio in a series of talks called Fireside Chats, which went a long way towards restoring public confidence. During his first 100 days in office, there were several regulations that were passed to stabilize industrial and agricultural production, create jobs, stimulate recovery, and, based on the lessons learned, implement some corrective checks and balances. Wait, what were the checks and balances? Well, the first one was creation of the Federal Deposit Insurance Corporation, or FDIC, to protect depositors' accounts. And the second was the Securities and Exchange Commission, or the SEC, to regulate the stock market so that abuses that led to the 1929 crash could be prevented. So today, when you go to a bank and you see the sign that says FDIC insured, that is essentially telling you that your deposits are safe. There were several other programs that were implemented during FDR's time, and these came to be known as the New Deal that constituted the investment in infrastructure, like the Tennessee Valley Authority, which built dams and hydroelectric projects to generate electric power for the Tennessee Valley region. And the other interesting thing was that when the Great Depression began, the US was the only industrialized country in the world without any form of unemployment insurance. So in 1935, Congress passed the Social Security Act, which, for the first time, provided Americans with unemployment, disability, and pensions for old age. And right around the time that the Depression began to end, the US involved itself in World War II, thereby giving a boost to defense manufacturing, which produced more and more private sector jobs. So by the beginning of 1942, the unemployment rate had fallen below the pre-depression level. So the first two economic crises that we talked about both had a theme of speculative investment. People borrowed beyond their means to invest, hoping for phenomenal returns. But the next economic crisis was more of a demand and supply problem. I'm talking about the oil shock of 1973. In October of 1973, President Richard Nixon requested Congress to make available $2.2 billion in emergency aid to Israel for the conflict known as the Yom Kippur War. Immediately following that, the Organization of Petroleum Exporting Countries, or OPEC, which had most of its members from the Gulf, implemented an oil embargo on the United States and its allies. This meant that the US would not be allowed to import oil from the OPEC nations, and a series of production cuts were made so that the price of oil could be hiked significantly. The cuts led to the quadrupling of oil from $2.9 a barrel to $11.65 a barrel. In March of 1974, amid some disagreements within the OPEC members, the embargo was officially lifted, but the higher oil prices stayed. One question that comes up though is, wasn't the United States the biggest oil producer during World War II? Then why was domestic production not enough to meet the domestic demand? Well, by the 1970s, with all the growth and development, the US, which constituted only 6% of the world's population, was consuming 1/3 of the oil produced in the world. So the Gulf embargo was bound to have an effect on the economy. The second question that comes up is, was the Yom Kippur War the only reason that the Gulf imposed this embargo? Not really. There was a deeper reason: the unpegging of the dollar to the gold. In 1971, Richard Nixon formally ended the Bretton Woods system, where the price of dollar was pegged to gold, and that ended up leading the dollar to a free fall. Free fall not because of the unpegging to the gold standard, but because by then the US economy had been spending quite a bit on expansion, on the war in Vietnam, etc. So the price of the dollar was in need for adjustment. And this drop in the price of the dollar hit the Arab nations the most because their oil revenue shrunk because of the drop in the price of the dollar. So net result, even after lifting the embargo, the price increase in oil stayed unchanged. In August of 1974, Nixon stepped down from presidency and handed off the reins to Gerald Ford to continue to look for a solution to the runaway inflation that had erupted out of the oil shock. And how did Gerald Ford tackle the problem? Well, he used psychology to get control of inflation, asking citizens to wear "Whip Inflation Now" or "Win" buttons. No, I'm not kidding. This is exactly what he did. And if you Google the "Win" buttons from Gerald Ford, you can even see what they look like. His hope, though, was to encourage personal savings and disciplined spending to control inflation. President Jimmy Carter took office in 1977 and in 1978 appointed Paul Volcker as the chairman of the Federal Reserve Board. Paul Volcker was very focused on controlling inflation, and he achieved this by driving up interest rates. And in parallel, Jimmy Carter too was focused on reducing government spending, and he also began the process of deregulating industry. Inflation was still on the higher side, but it kind of stabilized around 1983. Now, one of the most positive outcomes of this crisis was expected to be the reduction in dependence on foreign oil and more energy independence, with a higher focus on renewables. And that started happening during Jimmy Carter's time to some extent. But once Ronald Reagan took office, he worked very hard to drive down the price of gasoline so that the Soviet economy could be hit, which in turn would impact the expansion of the Soviet arsenal. Well, Ronald Reagan succeeded in his mission, and our reliance on fossil fuels continues through today. The next major economic crisis to hit a big chunk of the globe was the East Asian financial crisis of 1997-98. The East Asian countries at the center of this crisis were for years admired as the most successful emerging market economies, often being labeled as the Asian tigers. The crisis began in Thailand when Bangkok unpegged the Thai baht from the US dollar, which set off a series of currency devaluations and massive flights of capital. In the first 6 months, the value of the Indonesian rupiah was down by 80%, the Thai baht by more than 50%, the South Korean won by nearly 50%, and the Malaysian ringgit by 45%. Collectively, these economies saw a drop in capital inflows of more than $100 billion in the first year of the crisis. So these East Asian economies had attracted a lot of foreign capital by going around some of the rules and regulations that would be true within the normal open economy. So their currencies were pegged to the dollar, which meant if at any point the economy showed signs of cooling down, there would be pressure on the foreign exchange value, and which is exactly what happened. That as the economies showed signs of cooling down, there wasn't enough protection from within the economy itself to ensure against a flight of capital. Now, the interesting part is that prior to the crisis hitting, the IMF used to sing songs of praise of these East Asian economies, and in fact, sometimes even chiding the other developing countries like India, Brazil, etc., for not following the model of the East Asian tigers. But once the crisis hit, the IMF came in with their guns blazing and set up very strict conditions to put in regulation within the economies to ensure against such issues in the future. And it saw the end of many political careers in East Asia, including that of Suharto, who had dominated Indonesian politics for more than 30 years. And that brings us to the biggest financial crisis since the Great Depression, the 2008 housing crisis. In the United States, the stock market plummeted, wiping out nearly $8 trillion in value between late 2007 and 2009. Unemployment climbed, peaking at 10% in October of 2009. And Americans lost about $9.8 trillion in wealth as their home values plummeted and their retirement accounts simply vaporized. And because by then the system had become globally interdependent, the 2008 crisis precipitated a worldwide economic collapse. So what was the cause of the crisis? Well, very similar to what happened in the Great Depression of 1929. Just swap the stock market with mortgage borrowing. Yes, as the housing values appreciated across the United States, borrowers started borrowing to buy more houses, with the same hope as in 1929 to be able to pay back with the proceeds of the positive returns. And the first hint of the depth of the crisis was evident in March of 2008 when investment bank Bear Stearns began to go under, and the US Treasury and Federal Reserve System brokered and partly financed a deal for its acquisition by JP Morgan Chase. And the final nail in the coffin was hit when investment bank Lehman Brothers finally collapsed on September 14, 2008, unable to find a buyer for itself. The most difficult part of this crisis was that one administration, that of George W. Bush, was in its last few months, and a new administration would soon take over. But there wasn't time to wait for the new administration, so the Bush administration itself had to take some action. And in October of 2008, a $700 billion bank bailout bill was established. It was labeled the Troubled Asset Relief Program, which allowed the US Treasury to bail out troubled banks. And in the process, they lent about $115 billion to banks by purchasing preferred stock. It also increased the FDIC limit for bank deposits to $250,000 per account and allowed the FDIC to tap federal funds as needed through 2009. Yes, the same FDIC that was established by FDR in 1933. Barack Obama won the presidency, and in February of 2009, a $787 billion stimulus package called the American Recovery and Reinvestment Act was passed. This plan granted $212 billion in tax cuts, $575 billion in outlays, including $311 billion for new projects such as healthcare, education, and infrastructure initiatives. An effort was also made to modify loans so that families could retain their homes and not get foreclosed. By October of 2009, the recovery was still very sluggish and banks were still very hesitant to lend. Though the consumer confidence and overall confidence in the economy started to build, it was only after 2011 that the rate of growth in GDP started going at a more sustained level. So looking back, with all the regulations and visibility that we had built into the financial systems through the course of time, how could this have happened? Many people blame the mortgage-backed credit derivatives as the reasons for the economic collapse. But the fact remains, the regulators were in cahoots with the gangsters. And this was very evident in one of the Senate hearings where the chairman of Standards & Poor's was asked how they had rated a lot of junk products as AAA. And his response? Well, we just give a recommendation. It is up to the client to accept it. The head of S&P making that statement in the Senate and getting away with it. That's essentially the various players in an establishment helping each other outside of what they are required to regulate so that the establishment overall makes more money and gets away with it. And on that note, we end this section of the program. On to the quiz section. Question from the previous episode. 9 out of the top 10 busiest ports are in East Asia. Which one is the only non-East Asian port in the top 10? At one time, one of the biggest and busiest ports in the world, the port of Rotterdam is now the largest seaport in Europe and the only non-Asian port in the top 10 busiest ports in the world. So the answer is D, Rotterdam, the Netherlands. Question for the current episode. During the Great Depression of 1929 to 39, there was one group of Americans who actually gained jobs. Was it A, Native Americans, B, women, C, young men, or D, people of color? One more time. During the Great Depression of 1929 through 39, there was one group of Americans who actually gained jobs. Was it A, Native Americans, B, women, C, young men, or D, people of color? The answer will be provided in the next episode. That's all we have in the current episode. In the next episode, we get inspired by the recent celebrations and look at the history of the United Kingdom and the fascinating unity between England, Scotland, Wales, and Northern Ireland. Till then, stay safe and keep exploring the why in history.